When setting financial goals, whether it's building an emergency fund or saving up for an upcoming event, it's important to know where to put those savings. Putting money into the wrong account may seem like a small blunder, but it can cause headaches down the line if, say, you need to pay for the event and you realize the funds are tied up in a 3-year CD. Plus, interest rates are on the rise today, which means choosing the right account can increasingly help add value to the money you save over time. Liquidity, interest earnings, fees, and other account details may all have an effect on whether an account is good for you. Regardless of what's going on with the interest rates, it's important to weigh the relative benefits of any new account, and remember that you can use different types of accounts for different purposes, like a savings account for your emergency fund and a money market account for your future home down payment. Retirement savings require a separate investment strategy to help you decide. We match the most common types of bank accounts with different financial and life goals, and here are some common types and the best ways to use each. Checking account. Intended to be your primary bank account, a checking account handles purchases, checks, recurring bills, transfers, and other types of transactions. This type of account comes with a debit card and allows for ATM withdrawals, checks, and transfers in and out of the account. But check the details because these services can come with fees. One downside of a checking account is that the interest rate is usually zero or very low, and they may be monthly fees if you don't meet the certain requirements. Who is it for? All banking customers, at minimum, need a checking account. It is only an account intended for high activity of daily living, spending, and providing easy access to your money. It's best for purchases, recurring bills, unlimited transfers and checks, ATM withdrawals, but it's not recommended for savings and earning interest. Keep in mind, are there requirement minimum balances to maintain, and if so, can you realistically and reliably maintain those balances without incurring any fees? Savings account. Savings account offer you a rate of return in exchange for keeping money with the bank. Best for planned expenses and emergency funds, they allow you to earn small return on your money, with interest rates at online banks are typically between 1 and 2%, whilst avoiding volatility in the stock market. Typically, you are limited to 6 transactions, withdrawals or transfers per month, but the Federal Reserve has waived the rule during the pandemic, and many banks still allow more frequent transfers and transactions. Who is it for? Anyone in a position to save money should have a savings account, if only to keep emergency savings separate from their daily checking account. If you have more than 3 months of expenses in your checking account, it's best to move the excess to a savings account. Savings accounts are best for emergency funds, vacation funds, planned tax payments, and house down payments. On the other hand, they're not recommended for frequent transfers, the bulk of your retirement savings, automatic bill payments, check writing, and investing. And make sure to keep in mind, you can have multiple accounts, one for a vacation, one for your next vehicle, and not be confused by what is in your emergency fund. Next are money market accounts. Money market accounts are the type of savings accounts offering some of the flexibility of a checking account. MMAs typically come with an interest rate higher or around with savings accounts, but also offer a debit card and a check writing privileges. Usually money market accounts are limited to the same 6 convenient withdrawals rules as savings accounts, but that rule may vary by bank. They often require higher minimum amounts, such as $2,500 to open. Who's this for? This is for people who are saving larger amounts of money that don't want it tied up in the stock markets or a CD, or something like a term deposit. These are best for emergency funds, college tuition, vacations, planned tax payments, house down payments, and debit card purchases. They're not recommended for frequent transactions or frequent transfers, the bulk of your retirement savings, automatic bill payments, check writing, investing, and small starting deposits. Keep in mind, interest rates on money market accounts may not be better than a savings account depending on the time. Many of the best rates between both accounts types are quite similar. IRAs or super accounts. Investment retirement accounts are designed specifically to help you save for retirement. There are two types of accounts, traditional and Roth IRAs. Both have the benefit of earning compound interest and can be opened at most financial institutions. Contributions to a traditional IRA are tax deferred, meaning they'll reduce your taxable income up front, but you'll pay tax when you withdraw your money. Roth IRAs work in the opposite way. You fund a Roth IRA with after-tax income, but you don't pay taxes upon withdrawal. For 2022, the maximum total contribution you can make to all your IRA accounts is $6,000 if you are under 50 and $7,000 if you are aged 50 or older. Both IRAs also have specific contribution limits based on your income. Who's this for? Anyone who wants to save for retirement. If you're currently in a lower income tax bracket, for example, a young professional just starting out, a Roth IRA may be a better option because at your tax rate, you will likely get higher as you earn more money throughout your career. This is best for retirement savings, college tuition with certain conditions, and house down payments, again with certain conditions. It isn't recommended for emergency funds, vacation funds, and funds you'll need in the near future, such as for frequent transfers. Keep in mind, you may incur an early withdrawal penalty, barring certain exceptions, if you withdraw your funds before the age of 59 and a half, so this account should be dedicated to retirement-specific savings. The final account is a brokerage account. A brokerage account is a cross between a traditional checking or savings account and a securities trading account. A brokerage account has all the functions of a bank account, such as deposits, withdrawals, and debit cards, and it also lets you use the funds to buy investment securities like stocks, bonds, and mutual funds. If you plan to invest heavily in security markets, a brokerage account can streamline this process. However, brokerage accounts don't offer tax benefits like IRAs, and unlike savings accounts or CDs, return on investments in security markets aren't guaranteed. This is for people who want to streamline access to the security markets directly through their bank account. It's best for investing in securities tradings and is not recommended for emergency funds, additional banking services such as home loans, credit cards, and car loans, and people who don't have a lot of discretionary assets. Keep in mind, there's always a chance that investment securities may lose value, so don't use a brokerage account for emergency funds. Also beware of commission or fees that your brokerage account may charge. Hopefully this video explained a few different bank accounts and options you have for storing your money. This all depends on your financial goals, and leave your thoughts in the comments on which accounts you currently have, and subscribe for more business and finance related content.